Hey, welcome back to Everything Money. As always, it's Seth. We welcome you in. Paul is here. No Mo today, but Paul and I are talking about some intriguing companies. Today, we're looking at Colgate-Palmolive. You probably use one of their products today. You just don't know. On my computer, look at all the brands they have. Ajax, look at all these. Of course, the toothpaste, Palmolive, Irish Spring. Paul, I know you love Irish Spring.
You're being funny?
I love Irish Spring.
Love Irish Spring.
I take it out of the box and I smell it like the old 80s commercials.
Although I don't like the one that has the pebbles in it and it like hurts my skin.
But I like the shape of the bar.
But unfortunately, I bought the full box of it, so I have to go through it, and it really hurts when I'm like rubbing it on my body.
I thought you hired someone to soap you up in the shower. So.
that was your job.
So this is Colgate-Palmolive. We're going to look at the stock price. We're going to use our 8 pillars to see, is this price justified? Is it overvalued? Is it undervalued? Is it time to buy, or should we avoid the stock? Now, Paul, you avoid a lot of stocks.
I do. That's my goal.
And you pick those 20 to 30 bangers because you want to find a really great deal and not buy high, but buy low.
But the good news is we look at these stocks still because if they're close, we can set reminders for ourselves, which will be available in our software soon to get an alert when the stock hits a certain price.
Speaking of the software,
let's go to it.
Let's go to it. This is the Everything Money software you can get as a Patreon member. And Paul's going to get after right now with Colgate-Palmolive Company. Ticker symbol is CL, baby. Let's get after it.
All right, market cap about $70 billion. PE of 26, which is a little high. It's especially high for such a big company that has such a wide brand range. You know, I mean, it's kind of, this just me screams the market of just expensive companies. 16% profit margin with a 61% gross margin. So 1x and 1 check. Seth, they have a dividend that pays a little over 2%, costing them $1.5 billion a year. And as we'll go through in the future, their last 12 months, they had $3 billion in cash flow. Why is that important? Because guys, dividends are not a guarantee. You got to make sure that they can afford their dividend with their free cash flow, because that's what you use to pay for your dividend. Really high return on assets, really high return on invested capital. That's phenomenal. Those are one of the highest we've seen. That's great. Something we've gotten away from, but I want to get back into.
Yeah.
Momentum. It's currently trading above the 100, 200, and 300-day moving averages and below the 25 and 50. That shows a lot of long-term strength in terms of momentum, and short-term, it's a negative, and it's got some negative momentum going for it. So far, 1x, 1 check.
Will you explain the 5-year return on invested capital for our new folks at 21%, 22%? What is that?
It's basically, in layman's terms, how do they deploy their capital and make money off their capital in terms of their equity and their debt? Obviously, you want a company that can make a high return on its capital relative to their cost of capital, which involves debt and what the market expects. That's way more than you should. Just know that you want a high return on invested capital, and we're going to probably add that to our 8 pillars at some point. That way we can do comparisons, especially within companies within the same industry. How does this company compare versus this company in terms of deploying its capital?
It looks like they have enough money to pay their dividend of 1.5 billion. But
yes.
Paul, talk about with a 2.15% dividend. When do our dividend investors, when do they start getting frothy at the mouth? Is it 3%, 4%?
Well, right now the market's like 1.3, 1.4%. So 2.15.
Nothing special.
Well, it's 50%, 60% more than the market.
Okay.
Right? So maybe they're okay with that. Maybe they're happy with that, especially with the fact that they're not paying out a big chunk of their cash flow. It's only about half. So when do they get frothy at the mouth? I don't know. Like, I see a really high dividend, I get worried. Is this sustainable? Mm-hmm. Is this because the stock has fallen, but for good reasons, and then they won't be able to pay this dividend? Those kind of things. So, being above the market, okay, pretty good.
All right, using our 8 pillar systems, pillar number 1 was PE, pillar number 2 is profit margin, and pillar number 3 is revenue growth over the past 5 years.
15.2 to 16.72. That's a check. But look at 10 years ago, 16.94. Wow.
So no growth here, Paul.
Well, I would wonder if they sold off divisions. A lot of these big companies, they'll sell off brands here and there. They'll sell off companies. So that's something to check on the cash flow statement. It'll tell you what acquisitions and dispositions they did in the investing section, because you don't want to just assume that because revenue is down over 10 years, it's a bad situation. What if they sold half their business? Mm-hmm. And all of a sudden that looks really good. I'm not saying they did, but this is the whole point of the 8 pillars. It tells a story to get you to ask more questions later if the stock is trading in an area at a price range that makes sense to you. All right.
Yeah. If you're a patron and you have the software or want the software, you can go into the annual reports here in our software and look the 10K up for this company, the most recent 10K, and get after what they're selling, what they're doing, what they're selling off. It's awesome part of the 8 pillar software. So, all right, Paul, let's keep going. How about profit growth?
So profit growth. We went from 2.48 to 2.66.
Uh-oh.
I mean, look how consistent this profit is for the last 10 years. 1 year, that's it. That wasn't between 2.3 and 2.5 billion, 2.2 and 2.5 billion. That's it. I bet you there was a write-off this year too. So it's pretty consistent.
I hit the wrong sound effect. It's growing. I check for pillar number 4. I sometimes do that.
Seth, you have like 4 buttons to master.
No, there's 16, Paul, and it's very difficult to host the show.
Why don't you put a sticker on each one that says what each one is?
That would be too wise. You know that.
What was it? Yesterday we were at Home Depot. And we go. We ran into each other at Home Depot.
We go
and I'm
together.
like, "What are you here buying?" He's like, "A hose." I'm like, "What are you?" He's like, "What are you buying?" I'm like, "Containers." So we go to the container section, and he looks at. He's like, "Oh, look at these black containers." I'm like, "I buy the clear ones so I can see what's inside of them." He goes, "Oh, you're a very smart man." I was like, "Who buys?" I mean,
Me. I didn't even think about it.
I was like, "I'm doing storage here. I want to know what's inside the container."
How about shares outstanding for Colgate-Palmolive? Are they selling off? What are they doing, Paul?
They are 884 million down to 848. So that's a check mark, about 5% lower, almost in terms of shares outstanding.
Pretty good. All right. How about current assets over current liabilities?
Current assets, 4.56 billion. Current liabilities, 4.54 billion. So they can barely cover it, but it's a check nonetheless.
Check, please.
Perfect. All right. The free daddy of them all, the free cash flow granddaddy of them all, free cash flow growth, Paul. What
Now,
is
guys, I add this line.
Oh,
as a
so
user,
nice.
you will get to see this line. Uncle Paul makes this very easy for you.
Yep.
Add the line because it's cash from operations less your capital expenditures. 2.62 to 3.11, check mark there with an average of 2.75. Very consistently. 2.75 times our imaginary number of 20 is $55 billion.
Yeah, the actual retail market cap of this is 70 bill.
So it's not far off if you're assuming this. Now, what we have here, so it's still an X on this last one.
We got a slow growing company here, Paul.
We did, that's the thing. We have a slow growing company. So we have the 8 pillars here. And as it shows right here, we're at a PE of 26 and a price to free cash flow of 25, but everything else is a check.
Oh, I know where you're going with this.
What is that? What am I going with?
Just price, right? I mean,
Yeah, that's all it
with
is.
Strong financials, it's just the price is too high at the moment.
That's it. So the price is too high. So if you like a company like this, maybe set a target. So what should we do, Seth? We should go to our stock analyzer tool.
Before we
correct?
do that, yeah, if this type of investing or this type of looking at stocks speaks to you, and it may not speak to very many of you, we've found, but if it does, you can become a patron and have this software immediately. You get the 8-pillar software, you get the stock analyzer coming in July. Paul has dumped hundreds of thousands of dollars into this technology, into this software for our patrons, and you can join our community of 3,600 patrons all over the world. Click the link below to join the Patreon and get the beautiful software. Now, Paul, you're in the stock analyzer tool, which after we find out what our market cap should be in our minds, we can then transition to what should we be paying? How does that translate into stock price? So Colgate-Palmolive is currently trading at 81, very, very close to an all-time high, which is, you know, for this channel and many value investing channels, we do not want to pay all-time highs for companies. We'd love to pay very, very low for them.
Yes.
And watch them grow. Go ahead, Paul.
So what this analyzer tool does, it tells you the 1, 5, and 10-year annualized changes for revenue growth, shares, profit margin. Now, profit margin is the average. Free cash flow is percentage of revenue, also an average. And it asks for low, middle, and high assumptions. What this will tell you is what you should pay for the stock. Now, does this mean go out and buy the stock if it hits it? No. It means still do due diligence to understand if you want to own this company, but it'll give you a very quick feel for if the stock is overpriced or underpriced. If the stock is above every single number here, all 6 values, because it does it based on earnings multiple and free cash flow, if it's above all of them, then you want to avoid it. If it's below all of them, you look at it. If it's above half, then you look further. The whole point is it tells you, oh, wait, I should look at this more. Or no, you know, I'm wasting my time. Let me just move on. Good investing is about eliminating possibilities as quick as possible to find the good opportunities, right? So I hit the analyze button. I go below, and guess what? The stock is at 81 bucks. I have a range of 23 to 69. So I'm looking at this saying, from the looks of it, it's probably pretty overpriced right now. So let's go up here and change a few assumptions. I assumed no revenue growth is my worst case. Let's call it 2, 4, and 6% revenue growth. Which, by the way, I want to make note, they haven't gotten 6% at all in the last 10 years, at all, right? So this is quite aggressive. But it'll show you how overpriced the company is. It still hasn't hit the price yet. 877 is the highest price we get versus 82. It still has not hit the price yet. So guys, I think this is an overpriced company. I think it's evidenced by the fact that it's slow growing. And it's kind of hard to justify a higher price when you're slow growing. So for those out there who say, Paul doesn't care about growth, I absolutely 100% care about growth. It is part of my stock analyzer tool. It's the very first line of my stock analyzer tool. I would just wait for better times to buy the stock. When is 26 or 32 low? Probably. But is 40? It probably usually ends up being around the middle range of my estimates. So let me go put my original estimates in here. Yeah, it's probably in the mid to high 30s. That's where I'd probably be on the stock. Paul, that's a fall in half. Well, yeah, it's selling for 26 times earnings, 26 times free cash flow. Makes sense. With a slow growing company, you probably want to pay pretty close to single digits as you can to get a good return out of it.
I always wonder, Paul, is something would have to happen for this company to fall
Yeah,
this
just a taste
far.
change. That's it. It happens all the time.
It does.
You know, in Joel Greenback's book, the little book that beats the market, he has a suggestion. In it, he says, go look at any stock you know and go look at the 52-week high, 52-week low. They're drastically different.
Yeah, this book right here, folks, the little book that beats the market. This is how I invest, and a lot of our patrons are doing it as well. But yeah, you're right, Paul. I mean, I guess I would think to myself, if it does come crashing down, then there is some hesitancy. Wait, what the heck happened? Why would I invest in it now? But you like to set your price targets early to know, put it on your watch list, and maybe if you're really interested, start looking into it at that price.
Stocks on an individual basis will fluctuate a lot in a year. Just be patient. We just happen to be in a very, very exciting market right now, and it's hard for stocks to go down, but it will happen. And when it does happen, you'll be able to pick up stocks like this, probably closer to this number than you think. You might be shocked to believe that, to the point where you're gonna be like, why is it so cheap? I don't get it. That's the question. That's when you know it's a value investing market, is when you're like, how is this company so cheap?
We'll get there. And
we always do.
And we'll be here when you need us. Tickle the like, join the Patreon, get a Tesla that we're giving away at 100,000 subscribers. Thanks, guys.